Yeah, people usually come on between 4 and 4:10, so they'll stream on throughout the next 60 minutes or so.
Gotcha.
And it'll give us a countdown here, 3, 2, 1, and then we'll get locked and loaded here. This will work. Hopefully it will. Okay. Yeah, it usually gives us like a 3, 2, 1. So just hold tight here. Come on, beat that live. All right, if it doesn't give us a countdown soon, I might have to refresh, so bear with me. Give it like another 10 seconds.
Okay.
All right, I'm gonna try clicking refresh on the browser. So just try coming to the same linking, but hopefully it'll let you stay on.
Okay.
Okay. Now it's wow. All right, let's try again here. Oh, here we go. Hello, welcome back to another episode of Rapid Results with Andrew Weiss. We have an incredible guest today, the wonderful Laurie Barkman, the Business Transition Sherpa. And in case you don't know who this Laurie person is, let me tell you a little bit about her. Laurie is the former CEO of a $100 million revenue company that was sold to a Fortune, not 100, but a Fortune 50. Her firm, SmallDotBig, Laurie guides business owners through the often overwhelming process of transition planning. And she's a mergers, acquisitions intermediary with Stony Hill Advisors, and she facilitates sell-side and buy-side transactions in the lower middle market. She's an Amazon best-selling author of the Business Transition Handbook, How to Avoid Succession Pitfalls and Create Valuable Exit Options. She's a professor at Carnegie Mellon. She's hosted award-winning podcasts, and she loves helping entrepreneurs and business owners around the world. Ladies and gentlemen, please welcome Laurie Barkman.
Hey, Andrew, it's great to be with you today. Thanks for having me.
Yes, we're excited to host you. And Laurie, tell us, what is the biggest and best business deal you're most proud of? Or if you want to expand on that $100 million sale, you feel free to dive in about that too.
Yeah, you had a great lead in for me there. It was an amazing experience. I was hired in from the outside as part of a long-term succession plan to run a subsidiary of the business. And that was my business unit. That was about 100 million. It was a pretty big company. It was over $1 billion in revenue. And it took a team to build this company, right? It was a third generation company. My boss was in his 60s, early 60s at the time, and he was third generation. So it was a 120-plus-year-old company. And wow. What really impressed me about this company and the whole transaction was it just end to end, right? From each generation to the next, what they did differently. And it was such a success story for the family, for the teammates, for our stakeholders who were invested in the business, and for myself and the other executives that worked on the M&A deal and through the integration. It was an amazing learning experience. Of course, it was challenging and it had its ups and downs, as things always do. But for sure, it set me on the path that I'm on today to work with entrepreneurs to help them on their journey.
And that's so cool. And I'm curious, like, how were you chosen to help be that person that would help them be a successful exit? Like, I'm sure it wasn't picked out of a hat and go, oh, Laurie, you're so lucky. You're going to help us do this. Like, tell us a little bit more about that process of how you were selected to do that.
Yeah, a lot of business owners are really good at building, but they're not doing it alone. They have a team around them. And I think what more and more people are realizing is that there can be a team of business owner advisory team, the boat, and creating that boat to help you on the other side of the building, right? As we look forward to look backwards, what's needed to create a business that has the value that you're anticipating getting out of it one day. And we can't do exit planning when we're exiting. So it's really important to not just build your business with a great team, but also when you're thinking about a transition, to have a great team. So what I do is I educate a lot. I do a lot of podcasts. I have my show, I have my book, and soon a course. What I find is that business owners who are coachable, who are interested in learning, and who have a transition mindset can take the time, and it'll pay off the multiples are there. If you can spend the time and double the value of your business, why wouldn't you do that? And the secret in all of this, Andrew, is that the sooner we have the mindset towards building value, towards a transition in the future to a future buyer, you can run a more valuable and more enjoyable business in the short term. Why wait to have that perfect business, 20 years from now when you're ready to retire? Start doing it now so that you can get the gains on the value and really be ready to exit at any time.
That's so fascinating that you say that you can't just plan ahead once you're 10, 20 years down the line. Like, you believe in no, once you start a business, you should plan to exit immediately, it sounds like.
There are definitely schools of thought that say when you're running your business plan, you should write it with an exit in mind. Think about the venture capitalists of the world and the venture startup types of technology companies. When they write their business plan and they're meeting with venture people who are going to invest in their business, a lot of times in those conversations, Andrew, they're getting asked the question, well, what's your exit strategy? Well, why is that just reserved for companies that are venture backed? Why should they be the only ones thinking that way? I'm not saying necessarily do it day one, but if you're not doing it on day 20 or day 30 or day 50 or 10 years down the road, what are you missing out on?
And what about for like personal brands, like the Laurie Barkman brand? Like, can you exit from that brand too, or you're talking about companies that have no name, like Apple, Microsoft, things like that?
My focus is the lower middle market, and so let's
Gotcha.
define that a little bit. It's really the smaller end of the lower middle market. It's not necessarily the solopreneur, although a solopreneur can definitely create a company that someone wants to buy. So let's talk about this in a couple different ways. One is a business that is attractive to a buyer, a business that is transferable to another owner, and one that doesn't necessarily have a lot of risk associated with it. So there's a value perception. So it's attractive, it's transferable, and you're not going to get it as an owner and go, oh my God, what did I buy? Right?
Yeah.
And those criteria can fit a lot of businesses. The question is, well, who's it a fit for? That's why if we can reverse engineer our exit, I like to talk about building with the exit in mind. What's the end game? And let's say we're a service business and we don't have recurring revenue. We have project revenue. We have one-time clients that come, maybe they come back, maybe they don't. Maybe we don't have contracts, and contrast that with a company that has recurring revenue, maybe a very high % of recurring revenue. We all know Netflix. It's the best example. You put in your credit card, you forget about it, you pay every month, and they have subscribers. Well, there are businesses that have productized their service. And so even a service business, yes, a service business can create a recurring revenue program. So tying it back to the idea about who's the right buyer, if there are buyers out there that are really looking for a high degree of recurring revenue in certain industries and yours doesn't have it, well, why not? What if we find out that, hey, this is a pretty important criteria from a potential buyer down the road, whether it's a strategic buyer, whether it's a financial buyer. And if you have time on your side, you can make changes. There's been quite a few people coming on my show in the rearview mirror talking about, well, what did they do differently? And one such example of that was a guy who came on my show and he said, yeah, he'd been talking to potential buyers for 6+ years. He had understood pretty clearly what they were looking for. And it was painful. And he and his business partner did it. They made a pretty big pivot going from 100% project revenue to about 45% recurring. And it paid off for them in a pretty good exit.
And so to kind of summarize what you said so far, it sounds like that's one of the cores of creating a company that's easy to transition from, or easy to sell, is making sure there's reoccurring revenue set up in the company.
It's one of the criteria. I think, honestly, the biggest would be you should have a company that can thrive without you. This goes back to your question about the solopreneur. How transferable is it if you are the one who does everything? You're doing all the bottle washing and delivery and creation, as opposed to setting up processes, having a team. And I'm not necessarily talking about just a W-2 team. They don't have to be your full-time employees. They can be virtual teams, virtual staff, partial 1099 folks, contractors, processes that are documented in writing, on video, whatever it takes to run a seamless operation. There are plenty of businesses, I read about exits all the time, that surprise you, right? The 9-figure exit from the 9-person company, the 8-figure exit from the 2-person company. These are happening every day.
Yeah.
It is possible, but think about the attractiveness of your business to a potential buyer. What are they motivated for? What problems is your company solving for them? And then when they take over, how seamless will that transition be? And how will they grow it? There's a number of different criteria, Andrew, and recurring revenue is just one of them. Having an operational independence from the owner is another.
That is so cool. And I love how I could tell it's like you help people with this or something like that.
Yeah, maybe. Maybe I do.
Yeah, that's so awesome. So let's, and so I'm excited to talk about your course too, and later on, but I want to talk a little bit about, so outside of planning for recurring revenue, be able to take yourself out of the equation, is there anything else that a lot of people get wrong when it comes to scaling their companies?
Yeah, I think a big one is financials. If you're a small business, it's pretty easy to ignore the back office. It's not that fun. It's administrivia, right? It's for some people, it's just, they hate it. They're not wired that way. For others, they love it. And then that's the cost of business. We've got to balance ourselves out with the front office and the back office. A lot of companies use software platforms like QuickBooks, which are great. No issues whatsoever. The main thing is to be consistent. If you have QuickBooks, but you are inconsistent year to year with your general ledger and how you're characterizing things. I have a client who's a small business that has had a turnstile of bookkeepers, and they every year have changed what he's been doing. And it's so frustrating for him. He finds that he can't get good clarity when he looks at his expenses year to year for comparison. So that's a basic, that's just table stakes. Make sure that you have good, clean financials, that you are, if you are operating a business that is what I'll call a business that's a lifestyle business, and you're trying to maybe minimize your taxes, hey, great, that's a strategy. I get it. But think about it when you're presenting your company for a sale to a buyer and you're showing no profit. Just think about that, right?
Yeah.
It just maybe, if you're expensing the toilet paper and saving 30 cents, as opposed to taking that dollar and creating $3 with it, we might make different decisions.
Well, and forgive me if I'm being ignorant here, but when it comes to Uber and Amazon, weren't they not making money for years? And they were so how does that work as far as being able to value a company that's not making any money versus making sure that you're showing you're making money so you can properly value it, kind of thing?
Well, it's so interesting to think about the private markets versus the public market. You can find out how investors are being speculative about company value by going to Yahoo Finance and Googling a stock, and in 2 seconds finding what the market cap is. In the private market, it doesn't work that way. There's an infinite number of prices that can be put on a company because it's in the eye of the buyer. And so how do buyers ultimately value privately held entities? This is the question. This is the art and the science of valuations, and why I find it really fascinating, and I enjoy it. And what I do is I put all my years of executive experience and experience in different industries, coupled with the knowledge from being a certified mergers and acquisitions advisor. And I can truly say there's an art and a science to this, because we do the math. There's a methodology of how we do the math. Investment bankers do the same thing. It's the same math. Okay. So we quantify. What are we using? We're trying to get data from different databases. How recent were these transactions? How similar are they to the company in question, by size of revenue, by industry? And certainly if we can get to geography, yeah, that's ideal. It doesn't always have to be the same state, but if we have that information, sure, it's helpful. So that's part of it. The other part of it is these factors that can move the needle on the value of our business. They're a little less tangible than the fixtures and vehicles and other aspects of your business. They're intangibles, And there's some of the things that we've been talking about today, right? One of them is your financials for sure. The other is the industry you're in, the size of the business you're in. One of the things that you might find interesting, Andrew, when you talked about inherently, when you said that the solopreneur, maybe what you were insinuating was revenue. And we don't always see a correlation. You can have the really small companies have large revenue numbers, but yeah, those are a little more rare. So let's just take the average company as we look at the bar chart. As we see revenue going up from $1 million to 5 to 10 to 20, it definitely spikes. You'll see valuations have an inflection point around 10 million in revenue. And a big reason why is because the more mature company is viewed as probably more robust and able to transfer and not necessarily so dependent on its owner, right? So if you've got a 10 million business, and are there exceptions to that? Of course. But in general, that's what the data shows. The other aspects of value drivers have to do with risk mitigators. One of the things we need to do is take a look at our revenue concentration. If we're so excited that we got that huge contract last year, but we look at the numbers as a percent of total and realize that it's 80% of our total, oh my goodness, that could be a red flag to the buyer. What happens if that buyer doesn't come back? What happens if, how can this business scale? They're wondering, if we own this business, what would we do differently? What are the things that have been proven by the existing team to show that there's growth potential? And then do they have field left to plow? There was a guy who was on my show who talked about his Y2K business. And as the closer the year got to the year 2000, he saw the value of his business deteriorate. He essentially hung on to his business too long. And it went from a 30 million valuation to 0. And it was devastating. He went through divorce, he went through bankruptcy. So the message is, look, there was a tremendous upcurve when he and his peers in his industry were serving the Y2K problem. But once that problem was evaporating with the time clock, what's left? I have a client now, to his credit, he acquired a piece of new business. He said, well, there's some regulations that are supposed to last 10 years. I'm going to grow this thing and then I'm going to sell it so that whoever buys it has a remaining time clock on that legislation. I said, good for you. You've read my book. You're working with me. I could have hugged him over Zoom. I was so happy to hear him say that. He was listening, right? That's the kind of message that I think all entrepreneurs should hear, is you need to have a mindset for the future, and the owner's metric is what you should be thinking about. Don't just get the glossy revenue, glossy eyes like, oh, my revenues are growing. Yeah. Well, what about your profits? And then what is your business worth today? And what could it be worth in the future if we invest and double down on the areas you want to?
That's such an interesting, fascinating piece of information, because it reminds me of like the saying, there's lies, damn lies, and there's statistics. And so like when you mentioned like, oh, look at us, we're such a big company, we just made 10 million this year or something. And then you find out 8 million came that from a lucky deal. And then you're like, okay, so how much is your company actually worth? And so that's so interesting to look for those kind of things. Another thing too, that so I know part of an incentive of growing and scaling a company is, I know, and maybe you can say if I'm wrong on this, but in general, like usually when you buy a company, usually buy 4 years worth of revenue of it, for example. So if a company's making $1 million a year, you buy it for 4 million, along those lines. Well, first, any thoughts on that statement outside of the 80% deal thing?
Yeah, absolutely. Let's unpack it, because I think there are potential some misnomers in that. If we are talking about a recurring revenue business, like a software company, like a service company that has a very high degree of recurring revenue, they have contracted revenue. That's the difference. There's a difference between recurring and reoccurring, right? With an O. Reoccurring revenue means it might come back. We don't know when and we don't know how much. Now, maybe these are handshake deals that have been made 15, 20 years ago. In multi-generational companies, it's very common that, grandpa had this relationship with this other fam. Well, guess what? Grandpa passed away. Their grandpa passed away. Now the next gen has brought in a procurement department and it's going out for RFP. Oh, poop. What are we going to do? That becomes a question mark. And if you take that example and say, okay, well, how might I apply that to my business? Not all of my revenue is contracted. Well, how does the buyer perceive it? The buyers want a predictable stream of future cash flow.
Yeah.
The more predictable it is, the less discount they will put on, which is the inverse of a multiple. So in that case, then it could be likely that those types of companies would see a multiple of revenue. Most often in the lower middle market, okay, most often we are seeing a multiple of EBITDA, or what's called seller discretionary earnings, which is a proxy for net income.
Mm-hmm.
Okay. So the misnomer a lot of people have when they talk about valuations or multiples, they'll say that so-and-so's company sold for a multiple of 4. And I want my educated audience to go, multiple of what?
Mm-hmm. Multiple of what?
Multiple of what? And then that person will go, oh, I don't know, which means they don't really know what they're talking about. They're just hearing something and then kind of regurgitating it. And I want us to have the understanding that not all companies will be valued on revenue. You can do the back math, but that's not usually how it works.
Interesting. And then kind of secondary question to that, and maybe this is the same answer too, but let's say your company's making 100 grand a year, 200 grand a year, well, first, like, so would you say that the 4 rule, that is a general rule, or it's a complete myth, or it's a made up wives' tale? Like, how would you address that ×4 rule? Or like you can't answer it because there's actually so many more layers deep of research you have to do on top of that kind of thing.
Yeah, of course, my favorite answer is it depends. But yes, your multiple is a function of many things. Mm-hmm. It is your financials and your absolute numbers of profitability, and on other factors. It's the industry you serve. It's the growth potential, the degree of recurring revenue, the degree of transferability and dependence that your business may have on you. Other risk factors that may appear, such as revenue concentration or customer risk, employee risk, process risk with suppliers, for example. There's also kind of the flip side of the bogey, right? If we have a very good customer satisfaction and good acquisition, pretty low acquisition costs, high retention, those things interplay too. So that's the up and the down of the valuation. We can look at past performers in the industry and try to get an estimate range of value. And this is what I was saying earlier, Andrew, this art and science is we need to up and down based on the reality check. If you have a house on a block and yours is the smallest house on the block, but you've renovated it and it's gorgeous inside, maybe there's a buyer who's willing to pay more. Or if you take 2 houses that are exactly the same, but your neighbor's got the jacuzzi and the wine bar in the basement and you don't, yeah, chances are for the exact same property, exact same floor plan, they're going to get a higher, purchase price than you will. And I think it's the same with a business. We always have to get into it to understand what are those dynamics of why it would get the value it would get. This
is all so cool, and it sounds like you go on 1,000 more podcasts because being in the business world, and grants haven't been part of a acquisition or selling process before, but I would not have guessed like how many factors actually go into this, because like you say, it seems like most people just look at profit and go, oh great, you're making this, sounds good to me, and then they don't look at all the other factors. And so do you like helping businesses sell more, or do you like helping businesses acquire or buy more? So tell us, like, which one do you like to do more of?
Well, an ideal client is an end-to-end client where they've worked with me to create value and transition with success. That doesn't happen overnight. That's a 3 to 5 year engagement to get ready to have a plan and to address the areas of our business that need to be addressed. What that means for an entrepreneur is to work on the business and not in the business. They've got to make time to do that. If they don't, they're probably going to leave money on the table. And I will also argue they'll probably leave their happiness on the table. There's too many times that owners exit and they exit with regret. I don't want them to do that. And if they work with me and they create a strategic transition plan, they're also going to know some hard numbers. They're going to know what their business's baseline value is today. They're going to know what they want it to be and why. And then depending on how many years we have, we can set some goals. Maybe we can grow and hit those targets and close the value gap with organic growth. So that's sales, that's marketing, it's things that we control within our four walls. It's innovation, right? Then on to your question about growing through acquisition, if we can't accomplish our growth targets by organic only, then we may want to go on an acquisition strategy. And yeah, then I can work with them on that. And I find that very interesting and compelling. And then on the sell side, I love it when a client is ready to sell. There's difference between sell ready and ready to sell. There's a difference, right? Are we ready? Is our company ready?
Yeah.
And there can be a discrepancy. I've had on the buy side, we've approached a small company. They're like, great, we're interested. And they can't even give me financials. I mean, that's clearly not a sell ready business, right? And so the more time you've put into thinking about this and thinking ahead, the more likely that when a little bluebird comes your way and knocks on your door and says, hey, we want to acquire you, you say, hey, that's great. Let's take a look, and not let those opportunities pass you by. So I enjoy all of it. And I enjoy it when there's a holistic view and process around it.
To tell us a story, I mean, outside of the $100 million transition, of a client you have enjoyed helping go from A to B or zero to hero, one of your top examples or comes to mind. I'm curious about a story of you helping a client that you'd like to tell.
Yeah, I'm going to share this story because it was my very first client. And, you know, I shared this $100 million, business I ran, and the whole company sold for a very, very big number. This is a small company, and maybe people listening can relate to it. You know, it sold for less than 500K. All right. So it was a small business. It had been around for 2 generations. The owner's in his 60s. He and his wife want to retire. And we put it out on the market and went through a process that ultimately, for good reason, my seller client walked away from the buyer for good reason. It just wasn't a fit. And we also think there were some ethical issues. And we saw that the buyer was not able to secure financing in a timely fashion and was dragging out the deal. My client got pretty significant deal fatigue, which again, totally understandable and makes sense that it happened at the time. So I was supportive of that. I wasn't going to keep him in it just to keep it in it and make it artificial when I knew it was the right thing for he and his wife to cut ties. And we parted ways as friends. I of course, would have loved to have that end in a transaction. Well, wouldn't you know it, months later, I mean, he was literally ready to close the business, kind of on an end of a calendar year mindset. And a couple of months before the end of the calendar year, so probably around October, we heard from one of the buyers who we had approached originally, who wasn't ready at that time because they had just done another deal and they were going through an integration. And he came back and said, I'm interested. What's it going to be? What will it cost me? And wouldn't you know it, we just closed that deal. So I think the moral of the story is there's probably a buyer out there for you. In retrospect, that first buyer we had wasn't the right fit, and it was the right thing to walk away. And also, the other thing that we learned from all this was trust. There was a very high degree of trust with the second buyer, and there was an erosion of trust with the first one. And so many times, Andrew, people come on my podcast and I ask them the question about their exit. And I say, what made it be the right buyer for you? And it's not always the highest bidder. It's the right fit. And for this particular client, there's a lot of lessons learned on my part and his part. A deal's never done, and it's never over till it's over. Would be the other takeaway.
That is cool. Just kind of, I know people. It's too bad when people don't know how to walk away sometimes, because I know it's just so tempting. It's definitely something I learned. When I was in Hawaii and I was at these little markets and they try and sell these little knickknacks and say $20 for this. I'm like, no. They're like, okay, how about $10 for this? I'm like, no. They're like, oh, I'll give you $5. It's only $5 for this. I'm like, you know what? I don't want it. I can't. Thank you though. And so that skill, learning to walk away, is definitely valuable. And I also, when you brought that word of regret, I thought that was super fascinating too, because as a business seller, I know it can go both ways. And I know there's a horrific story of people selling their businesses for, let's say, 1 million, and they see it grows to a $500 million business, and then they don't want to live anymore, kind of thing. And so I'm curious, what do you tell people when they're in the process of selling business, how to make sure that they also don't go through the regret process of selling the business and then watching it burn to the ground versus selling the business and watching it explode to hundreds of millions of dollars or whatever. How do you navigate that conversation with people?
Yeah, I mean, with regret, there's two flavors, right? We regret the things we do that we wish we did differently, and we regret the things we didn't do. So step one is to work with an advisor like myself or someone else that you trust to help you create a plan that you can exit without regret. Part of that is going to be value. Part of that is going to be your personal transition plan. And so much of it, Andrew, I think comes down to identity. You know, we feel so tied in with our business, especially if our name is on the door. And I think it's about 25% or 30% of companies are, personalized that way. And so whether it's a family business or you're the founder, of course, you're going to feel an identity shift with that. Also, if we are not so excited about a transition because of a death in the family, a death of a partner, your own health and wellness in question, those are reasons why you might be compelled for a business transition, and that doesn't feel great, you know? And so we want to be mindful of the contingency planning that we might need to put in place to protect the value of your business over time. When it comes to a sale and the new owners doing what you expected them to do, or they do something differently, that's really tough because ultimately it's up to them. They own the assets now. If it's an asset sale, maybe, and it's a strategic buyer, they've taken the pieces and parts. They've kept certain teams and let other teams go. That's part of it. And a sale to a strategic, you kind of need to know that that's probably going to happen. They all have a methodology and playbook. The strategic corporations, if that's who's buying you, you know, it's an institution that's buying you. It's not one single person. And it's an asset sale, meaning they want the assets of your business stitched in to their teams. They don't need 2 HR teams. They don't need 2 finance teams. They don't need 2 IT groups, most likely. And maybe they don't make changes for a year or 2, but then eventually they will. And I think owners need to be mindful of that change is going to happen. You can't think that someone's going to acquire your business and maybe just let it go on its own, certainly from an acquisition by a strategic partner. If it's a financial buyer, someone like a group like a private equity firm, it depends on the kind of deal, because if it's a platform deal, then yeah, maybe they want the management team and everybody intact and they don't want to touch anything. They want it as part of their portfolio. They want to buy low, sell high. They're going to push hard for 5 to 7 years and then they're going to sell. You got to know that going into it. That's kind of how it is. Another type of financial buyer that a lot of folks don't know about has a different time horizon. And that's a family office. Family offices that are doing investing in certain asset classes are looking to buy and hold for a long period of time. And they may want to just run it, let you run it as is. They're hands off. You know, they're not necessarily going to be in the operation. And I think that for all these reasons and all these motivations and what aspects your business solves for them, that's what makes it a fit or not a fit on both sides.
That makes sense. So just before the sale happens, making sure you're going into it knowing how you feel, how the company treats after they buy it. You know, you have to learn how to let go regardless after you make the sale, and of course doing your best to make sure you get the most value out of the sale in the first place. So yeah, that makes sense. Well, let's transition a little bit. I'm curious, tell us more about what do you believe are the non-negotiable actions of a business owner to be successful in their business?
I think they need to really own up to delegation, you know, and just realize that the value of the business might be held back by you. It's kind of a bold statement. It freaks people out when they realize that, because they're like, oh, wait a minute. You're right. Like, it takes a minute to kind of click in that a business that can't survive or thrive without its owner is a worthless business. It's a pretty bold statement.
Yeah.
But if we think about what I said earlier in the show, is it attractive? Is it transferable? You know, if a different owner owns it, what will they be able to do with it? Can they turn a profit and grow it like they want? And if they need you to stay on and do that, that's great. You might be willing to do that. A lot of owners need to think about what roles they would like to have post-transaction that's the work that I'm doing with them to help them think through in advance. Well, what roles might you be open to? And the answer might not be to sell. The answer might be, I got to bring in a management team. I need to be able to, take a step back, eventually serve as chairman of the board. Wait, we don't have a board. Okay, we're going to set up a board. That's an evolution of a company as it gets bigger. And I think for owners, just to have the realization that it is beyond them, it's more than you. If you are the key rainmaker in the business and servicing the product and right? All these things, don't be surprised to learn one day that your business is either not sellable or that it's sellable at a steep discount.
That makes sense. That makes sense. Just don't be the bottleneck. And there's another guy I was talking to who was helping business owners, and he was talking about how he had a fun game where he would have the business owner walk through their business, and then every time that they would talk about where they're involved, he would throw a pen at them and say, stop being involved there. And the guy would be like, okay. And so it's an important reminder, and it's too bad because, of course, the business is our baby and you want to grow it and be involved. But of course, if you play the long game, you can't be involved in everything all the time. So it's important.
Yeah, force yourself to go to the Maldives, take a really, splendid vacation for an extended period of time and see what happens. And it's sink or swim for your team. You don't want them calling you, at all hours of the night when you're on vacation. They need to learn to answer questions for themselves, solve problems, and address processes on their own. What can you do to enable them successfully to do that?
No, it makes a lot of sense. So I have a few questions left here, but first we want to know, tell us about, with all these nuggets you're dropping, all this amazing advice you're giving, apparently you have a course that you would like to tell the audience about.
Yeah, I'm really excited about it. It's called Endgame Entrepreneurship, Building with the Exit in Mind. And it takes all these concepts from the book and puts it into a course so that I am literally with you on your journey. It's really robust learnings and exercises and tools. So there's videos and ways that you can use the tools on your own. And of course, you can take your time in going through it. You can take as long as you need. But my encouragement also is that we're going to be launching a mastermind, and it's going to be invitation only for the people who go through the course, because we need a common language. And I think the peer group of endgame entrepreneurs is going to be a really, really cool place for people to maximize value and learn how to avoid pitfalls.
I love that. And I know you're offering a complimentary PDF of your book at the businesstransitionhandbook.com. Is that also where people can find more information on your course as well? Yeah,
absolutely.
Okay, awesome. Just double checking for that. And then I'm curious too, Laurie, as someone who is obviously an expert at this, has done it several times over, helped several clients over, what is it about all this that gets you fired up to wake up in the morning and help these people and help these entrepreneurs, business owners? What is it that gets you fired up about all this all the time?
I think there's a combination of pattern recognition and problem solving. Every company is a snowflake. Every company is different. Every entrepreneur is different. However, there are common patterns in what we see in building a business and eventually letting that business go. As a personal transition, as business transition, what creates value, what needs to be worked on, where the gaps are, those are all very dependent upon the companies and the owners. But that's where the problem solving comes in. And I think the strategy piece is really interesting to me. I think I've always been someone who can dive into a company and understand it pretty quickly. I don't know all the answers, of course, but I can, learn enough as needed to add value pretty quickly. And I think it's that piece of adding value to an entrepreneur to help them find clarity on the questions that have been swirling in their heads for so long. They are alone. They are alone in their own head. And it's a horrible place to be if you feel stuck, because you don't have anyone to talk to about it. You can't really talk to your team. Maybe your spouse is dialed in or not, and they want to talk about it. They don't want to talk about it. And I am that sounding board, and I am that person that they've been seeking, who can understand and empathize and then help them strategize to get to the next level, solve the questions they've been solving, and help them exit with success.
I love that. I love how your eyes light up when you talk about all this and, and how excited you get about it. Because, like you said, it's so needed. And I love how you help people no matter where they are in the journey, they're like, I guess maybe I should sell someday, even though I have no idea how. And then boom, here comes Laurie, or someone who's like, we have learned how to sell. What do we do? Boom, here comes Laurie. So that's so awesome to be able to help the full spectrum of people. So last two questions. How can we best contact you? I know you also have your podcast, the Success Stories podcast, Global Top 2.5% show. Congratulations on that. What other ways? And obviously you have your website too, thebusinesstransitionhandbook.com. But what other ways can we get a hold of you if we want to connect with you more?
Yeah, the one-stop shop is to go to my website, which is thebusinesstransitionSherpa.com. It's a mouthful, I know, but just remember the journey. We're all on this journey together. And on that site, you can find my podcast, my book, the course, and you can connect with me and set up some time, and we can talk. And we can talk about the goals that you might have or what's swirling in your head and help you set a path forward. The other thing I want to mention as a free tool is if they scroll all the way down to the bottom of the site in the footer, there's something called assessments. And there's two that they can take for free that people can take. One is a business assessment and the other is a personal assessment. And if you take it and want to discuss it with me, I'm more than happy to do that.
Oh, it's fantastic. And so the final question for today is, what's one thing you want someone to have from this? What's one takeaway you want someone to have from this interview today?
I think the takeaway from today is to realize that your business might be held back because of you. And isn't it better to figure that out sooner versus later? You can't do exit planning when you're exiting.
I love that. Well said. Well, thank you again, Laurie, for such a wonderful interview today and sharing all these golden nuggets. I'm sure people have been banging their head against the wall for years going, how do I figure this out? And then here comes Laurie to save the day. So thank you again for joining us, everyone. We'll see you next week for the next episode of Rapid Results with Andrew Weiss, and we'll see you all next time. Thanks, everyone.
Thank you.